finance fam, welcome back to my channel. I got a message in my Instagram DMs and it triggered me to want to do this video. Here's what it says, and I quote, "What do you think the Fed will do? All so stressful!" Exclamation point. That's an understatement. There has been a lot going on over the past week. And I gotta say, I'm tired. You're probably tired. We're all tired. The Fed may have officially done what we all thought they were going to do, and that's break something. In an economic environment that was already confusing, in the stock market, which we were already having trouble determining direction, we already had pulling forces, good, bad. We didn't really, have a clear cut direction on where we were going from here in the economy and in the stock market. And then pile on to all of that bank failures. So some of you may be sitting wondering, okay, now what? What do I think about what interest rates are doing, if we're going into a recession or not, what the stock market's going to do? All of these questions, I just wanted to address them in this video. I'm not going to go into too much detail on the bank failures because I did that in a video that I just released yesterday. I did an interview with Travis, who is my co-host of the We Talk Money podcast, and we covered everything in this video. So if you haven't already watched it, go to my YouTube channel. I'll link it in the description below. The title of the video is Your Bank Going to Fail? Go watch this video if you're wondering what the heck is going on with bank failures. The essence of today is going to be talking about what the Fed is going to do and what the stock market is going to do in relation to what the Fed is going to do. First of all, if we move over to YCharts and take a look at the S&P 500 technical chart, meaning we're looking at what the price action has done, how price has moved, and this is a daily chart. I'm looking at the past year of price action. We recently have seen a decline in the S&P 500 price, and the S&P 500 is basically the stock index that reflects the top 500 companies in the United States, and that's how we know the health of the stock market is by paying attention to the price of the stock market. And we've seen that price decline. It was interesting because we saw the stock market sell off recently because it sounded like the Fed was going to hike interest rates possibly even more than we expected. They were going to maybe do, instead of a 25 basis point or 1/4% hike, they were thinking about a 0.5% or a 50 basis point hike. And so that spooked the market. The market ended up selling off after Jerome Powell testified in front of Congress and sounded basically pretty hawkish that he was going to continue to raise rates. And we may even see higher rate hikes because things were kind of chugging along in the economy, as I've talked about a lot on prior videos where I outline the macroeconomic landscape. But now with these bank failures, everything has literally changed in a matter of days. So looking at like a treasury bond, they have different maturities of treasury bonds, and they have short-term maturities where it's just maybe you're holding a treasury bill for months. They have intermediate term maturities where you're holding for maybe anywhere from 2 to 7 years. And then there's longer dated maturities where you're holding treasury bonds up to 30 years. So sometimes what we do is we look at different treasuries and kind of look at how the rates are moving. And the 2-year treasury rate is one that a lot of people pay very close attention to. And you can see that this purple line is the 2-year treasury rate. I have just the year to date treasury just to show you how this has moved. If I go back, let's say 5 or 10 years, let me go back 10 years. You can see how much the 2-year treasury rate has moved in the past just year. I mean, this has been essentially the quickest rate hike that we've seen, probably, if not on record, in a very, very, very long time. So the Federal Reserve basically took rates from 0% to 4.5% on the low end. It's 4.5 to 4.75 is where the rate range is right now. But this is a very, very fast spike in interest rates, which caused big problems with people's assets, especially bank assets that they had on their balance sheet. So, zooming back in on this 2 year treasury rate, you can see how sharply it has gone down since the news of the bank failures. We were at a 2 year treasury rate of around 5%, and it declined a whole percentage point very quickly from 5% to 4%. So, this is a really, really big move. It doesn't look like much, it doesn't sound like much. Oh, 1% change on the 2 year treasury, but it is a big deal because of how quickly it happened. And 1% is a lot. What this is basically signaling is people are freaking out and they're flying to safer assets. They're flying to safety by buying bonds because bonds and interest rates have an inverse relationship. If the 2 year treasury rate is going down, that means people are buying the 2 year treasury. When people are buying the 2 year treasury, it means two things: there's a flight to safety, and two, they think the Federal Reserve is going to reduce interest rates. So what they're doing is they're trying to lock in the rate while they can because they think that the Fed is going to make rates go lower. So back to the question of what is the Fed going to do? I watched the probabilities of what the Fed was going to do with interest rates unfold in real time, and it was astonishing to see how volatile these probabilities have been. We have literally gone to the market thinking that the Federal Reserve was going to raise interest rates another 0.5%, to them saying that interest rates are going to stay the same or we're only going to see a 25 basis point hike. And that's reflected here in the FedWatch tool. And you can even see the volatility of these probabilities going back from February to today and how much they've changed. Basically, what we're looking at now is we went from having a 78% probability of a 50 basis point rate hike or a 0.5% rate hike to 0% chance of a rate hike from the Fed of 50 basis points, right? So, what we're looking at now is the market thinks that we're going to have a 46% chance of the Fed keeping rates the same as they are now, which is the range of 4.50 to 4.75%, and a 53% chance of them only hiking interest rates 25 basis points, aka a 0.25%. So, what does this mean? It means a few things. One, it means that things are probably not great for the Fed to go from the extreme of hiking 50 basis points to the likelihood of them not doing that and maybe even possibly keeping rates the same. That means that the Fed sees bad stuff out there. If they don't, continue on their path like they've mentioned to beat inflation and hiking interest rates, if they don't do that and these probabilities play out, that means that the Fed sees something wrong, something's cracking, something's potentially breaking, we're closer to recession. So, that's not the ideal scenario we want. The flip side of that is that the stock market could actually end up seeing this as a positive because basically the stock market wants to see lower interest rates because cheaper money is good for growth companies, right? Cheaper money is good for people in the economy to have lower interest rates to buy homes, etc. So cheaper money, lower aka lower interest rates is a good thing overall for growth. But the big question here becomes now, okay, well what is the stock market going to price? Is the stock market going to price the fear in the banking system, the possible cracks that could continue? More banking issues could end up happening if this negative sentiment starts to spread. Personally, I've actually been surprised that the stock market measured by the S&P 500 or the Nasdaq has actually been holding up as well as it has. You would think with all the events that have unfolded, we would have seen much more panic in stocks, but we just haven't. And that's because I think that there is a pulling force right now with the possibility that the Federal Reserve could end up pausing or slowing down their interest rate hikes. And the benefits of that could happen throughout the economy are pretty significant. And I think that's what the stock market might be looking at. Whether they're right or wrong, I can't say, right? But I think that could be explaining why the price of the S&P 500 could actually be holding up here. The good news is we did get some inflation data recently, and the trend is continuing in the right direction. We are continuing to see inflation decline. And if there's fear right now, if people are feeling on edge about the banking system and they maybe pull back on spending, that could end up continuing to help inflation decline, which in turn would make the Fed maybe slow their roll with being too aggressive with rate hikes. They've already done a bunch of stuff, right? They're already starting to break things. And so maybe this is their cue. Hey, okay, maybe now we can slow down. Banks are failing, inflation's coming down. Maybe we can chill a little bit and see where this goes from here. I think the market would really, really like that. So, is this the start of a completely different narrative in the economy and stocks? Maybe. I don't know. It's kind of hard to tell and it's too early to tell. But if all of these depositors at these failed banks are made whole and there really aren't any truly terrible losses for businesses, small businesses, and consumers, then in the end, we may end up actually being okay. We have to continue to keep our eye on things like the unemployment data, the inflation rate, how disposable income is looking, which hopefully it'll start to improve, especially as oil prices come down, aka gasoline prices come down. And then we also have to look at things like retail spending. So, all of this stuff we're going to continue to look at, just like the Fed is, to give us an idea of maybe where the stock market is going to be going from here. Now, I think that these sell offs are great opportunities. I think that, I've talked about this before, how I am prepared to take advantage if we do end up seeing the stock market sell off more, take advantage of that with cash on the sidelines. And I am not afraid to invest for the long term going forward at all. I'm not feeling fear. I don't think you should be either. We always have a crisis that we have to deal with when it comes to stocks. There's always something. I'm still in the camp that the recession is likely going to be mild if we see it. Even though all of this seems stressful and watching the news is probably even more stressful because they're just throwing the information at you, stop, take a deep breath, and do this. Remember why you're investing in the first place. What are those goals? How far away are those goals? And do you really need to care that much right now? And then think about the panic as opportunity. I say this all of the time. When there's fear in the streets, you need to be paying attention. There's fear in the streets. You need to be paying attention. If you're an investor managing your own active portfolio and you'd like to invest alongside myself and expert mentors and get access to our insights and our weekly stock market updates and crypto market updates, be sure to check out the Skill Incubator wealth building community. That's where you'll get access to us and all of our insights and research and special classes that I host on building wealth better. Link in bio to join us in the community. And if you like this video, give it a like, subscribe if you're not subscribed. I'll see you next time. Stay calm out there.